Okay, well, welcome to what really is the first of this series. We're looking now at consolidation, which is IFRS 10 and 11, and we're doing this from the particular perspective of students who are sitting ACCA paper F7. Let me just check I've got the right name of that paper. They do keep changing them all the time. Yes, indeed, it's paper number F7. So F7 is the financial reporting paper down at the F level. It is, for those of you who've not watched my little video on what's going to be in the exam, relatively straightforward to revise for, because the examiner tells you what's going to be in the exam. He's got three main topics. The three main topics are consolidation, single company accounts. So single company accounts are where the guy gives you trial balance and some information about a company, and from that trial balance you have to produce income statement, balance sheet. And finally, cash flows. If you study those three questions, particularly go get yourself a revision kit, and also we'll be publishing how to approach certain types of questions. So get as many questions as you can. If you can't afford or it's too difficult to get the damn book, you can buy books that are a year old. Buying books isn't perfect for paper F7, but it'll get you well beyond 51% in the exam. Just do every single question. Having said that, it's a relatively new format with the multi-choice questions. Right, that's where we're going to start from. I have to tell you that I'm going to go through this lecture very quickly. The reason to get through this very quickly is that it's designed to give you a background of what you're doing. Having said that, in the exam, the examiner is going to give you two income statements, two balance sheets for a parent company, subsidiary company, and he's going to ask you to consolidate them. So it's an absolutely terrible thing to say as a tutor, but if you don't understand why you're doing something, it's not the end of the world as long as you can do it in the exam. So I'll go through this fairly quickly. It's very, very unlikely that you're going to get much of a written question on this topic, though. It's going to be numbers, always examined the same. So go through this fairly quickly. If there's something you really don't understand, then sit and slowly watch the whole video. If you still haven't moved on from there, send us a question and we'll do our best to help you in the office. Okay, let's move on to the next slide. Right, so we're just going to look now at some basic identification rules. Once again, when you're doing this in real life, and particularly like for people like us, when we're doing government sets of accounts, it's very, very complicated. If you're looking at paper F7, it's going to be pretty obvious because it'll be given to you in the question. Just when you are reading the standards, therefore, you can read the slide yourself. An economic entity means a group of entities combining a controlling entity, blah, blah. Controlling entity is one that has controlled entities, blah, blah, blah. And it goes through the list there for you. What you are interested in here, and this again is what's so important for people like me who work with government accounts, is when does there an actual requirement to consolidate exist? So when does a requirement to consolidate exist? As far as paper F7 is concerned, it's going to be obvious because it'll be given to you in the question. So once again, you can read the slide yourselves. But when we are looking at whether there is a requirement to consolidate or not, usually what we're looking for is we're looking for one power condition. Power condition means something that we can do to a subsidiary organisation, and we're looking for one benefit condition. So with the power condition, as far as paper F7 is concerned, the obvious one is going to be that you own 51% of the shares, and that will be enough. When you come onto paper P2 and higher levels, then you may find that you have to put a bit more time and effort into these things. So therefore, not only do we have the right to have 51% of the shares for commercial organisations, we have some legal right to have first claims on dividends, or that we can change strategy, or we can appoint directors to the board, or that there will be other factors. Paper F7, you're going to own more than 51%, and usually 60, 70, 90%, something like that. Read the slide. So these, therefore, are just indicators that power exists. We have the ability to veto operating and capital budgets. We can veto overall and modify the board of directors. We have the ability to approve the hiring of key personnel, and the mandate is established or limited by legislation. Please remember, my background is government accounting. Right, once again, for paper F7, nice to know these things, but you're going to be given in the question a nice straightforward company, and its name will always be P, and that it owns or purchases 60% of the shares in a company whose name begins spookily enough with S. and then you have to consolidate the two things. Right, and this slide is just more of the same. In the same vein, we have a golden share. Right, that's very unlikely to exist in private companies unless the golden share is owned by the government. So you have water companies, electricity companies, media companies, and so on. Special voting rights. The entity has the ability to establish or amend the mission or mandate of the entity, the ability to borrowing and investment limits. Once again, what you're going to do with these things in real life is build them into a checklist. Do we have these controls? Does company A have these over company X? If they do, then control exists. And they're all indicators that we have control. For paper F7, it'll be obvious from the share capital. Okay, remember what we said at the start? There will be at least one power condition and at least one benefit condition. So the power is the things that we can do to the organisation, and benefit is the things that we can get back from that organisation. Right, when I say that, it means that we are company A, there is a company X, a second organisation. We as company A have the right to do things to X, and we have the right to get things back from them. So now we're going to move on to the benefit, the power to do things and the benefit. So the entity has the power to dissolve, and we have the power to extract distributions of assets, be that money or be that other assets. So there's two things there. They would be examples of benefits which would make us think that we should be consolidating. And just here to give you, because we are going very, very fast here, this is the whole point of this, is that you go into an organisation, so you're in the Ministry of Defence or something in a government, and you say, right, well, if the Ministry of Defence is going to prepare consolidated accounts, what should be brought into those consolidated accounts? And that's what's really difficult. Under IFRS, which are applied to commercial organisations, it's considerably easier for the very simple reason that these things happen so much more rarely. What I wanted to give you, for those of you, some people learn best by understanding the theory of what they're doing. Most people will just do the questions and that will be enough. But if you're doing this, have a look at the questions, have a look at the theory if that's how you want to learn and it makes you more comfortable. You will find understanding what you're trying to do makes answering the questions easier. I don't think this is going to be an exam. Right, and so we go on. So other benefit indicators. Right, when we're talking about the entity, so once again, we are company A, there is another company, company X, and the question is, do we control them, and control them in such a way that we have to consolidate them. So here the entity, which is going to be your company A, has the right to a significant level of net assets in the event of a liquidation, able to direct the other to cooperate with it in achieving its objectives, and exposed to residual liabilities, and has an ongoing access to the entity. So it's more of the same. The exposure to ongoing liabilities is a bit strange as an indicator, benefit indicator, but it meets the test. Yeah? Remember, we have to consolidate usually if we have one power indicator and we have one benefit indicator. And that's all that we're doing here, is going through the process. If you're doing this at work and you're trying to learn from paper F7, then you're going to find this very useful, I hope. Right, this slide gives us some exceptions. So do notice, therefore, that if you look at the government can control what all restaurants do simply by changing the law. So if they really, really wanted to do something stupid, they could say, okay, fine, well, you're not allowed to sell chips. Right, if you're not allowed to sell chips, then technically we can control the actions of an organisation that wants to make fish and chips or chips. So therefore, should we consolidate? Well, there's an exception to all of this. No, regulatory bodies are not included in this. So issuing of legal regulation. Otherwise, Institute of Chartered Accountants would have to consolidate every single accountancy practice around the world because they can regulate how they do business. So that would be an exemption. And therefore, others which are economically dependent on an entity. So once again, where you have the government provides funding to an organisation because it wants to. The British government provides funding to the Arts Council to promote Shakespeare. Right, that does not make theatres which are putting Shakespeare on government bodies that have to then consolidate their accounts with the British government accounts. Okay, hope that's clear. Right, so what we're doing therefore is we're reviewing this idea of control, and we're reviewing the idea of control in the sort of sense of, so does this actually mean that we have to consolidate something? I'm going to give you a couple of little scenarios here. Therefore, so scenario one, an entity, so therefore we've got entity A may be able to control entity X, but to do that, it will have to renegotiate its current agreement, whatever that agreement is, whether it's a purchase agreement, a sales agreement, or whatever. Right, the current situation at the balance sheet date, therefore, is that it does not have control because it can't force them to. Now, you don't know what the further circumstances are. Maybe the debts are so big or something that effectively they do have control. But just with that little bald piece of information that you've got there, no, it would not control the organisation, and therefore those two sets of accounts are not required to be consolidated, because as at the balance sheet date, nothing actually exists. Right, in scenario two, an entity has the power to control another entity and can remove and appoint directors, blah, 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 standard stuff. But it's never actually bothered to do this in whatever 20 years of existence. Right, that one doesn't actually matter, because in that sense it can do if it wants to. And the fact that it's never done it in the past doesn't mean that it won't get a new chief executive who decides to yank some change in the future. So in scenario two, you would be required to control to consolidate the account. Okay? So what we've got in slide number 10, therefore, is a nice little slide, if I say so myself. And it's a nice little slide which summarises everything that we've looked at so far. So, you know, your question is do we need to consolidate? Well, to consolidate, we have to have control. So my question, therefore, is, well, would we say, therefore, that we had control on these things? Right, so here is your summary slide. Does the entity benefit from the activities of another entity? If it's yes. Does the entity have the power to control? Yes. Does the power govern the financial operating policies? Yes. Then it controls. And even if it only owns 1% of the shares, if those conditions exist, then it controls it, and if it controls it, we have to consolidate. Right, if it doesn't benefit, no. If it doesn't have the power to control, nothing financial, no. Then control doesn't exist. We may have some system of a joint venture, but at that point we don't have to control. Right, and that is just a summary of all of the slides that you've seen before. If you're studying this for paper P2, I think you need to know that. If you're studying it for F7, I don't think you're going to get asked it, but you should know it anyway. Very, very useful for work. Okay, so on slide number 11, therefore, now what are we actually doing? Well, it says that we're preparing separate financial statements of the parent company and the subsidiary using, and it says here a standard worksheet procedure. So we'll put the assets and liabilities as if they were a single accounting entry. And this process is required whenever we have a controlling interest. Right, if you can get this in your head, the maths becomes so much easier. What you are doing is you are preparing the accounts of an entity as if it were a single entity. So the assets of the parent company and the assets of the subsidiary company are subject to some adjustments we'll come on to, are basically added together. Right, when you look at the liabilities of the organisation, can you see that there's two entities? P can never have a liability to S, and S can never have a liability to P, because when you consolidate the two things, it's a single entity. So it's like saying, oh, you'll never guess what, I owe myself £50. Well, it's just a nonsense, isn't it? You can't owe yourself £50. The share capital of the organisation will be the share capital which is due to the shareholders outside of the group. So we get this idea that share capital, once again, the parent company can never have an investment in S, because it's like saying, oh yes, I invested £75 in myself. It doesn't make any sense whatsoever. And so it goes on. So you can never make sales to yourself, you can never have profits on sales from yourself, you can never purchase goods, you can never have anything in purchases from yourself. If one company's purchased stock from another, then you have to take that any gains of that stock out. You can't have share capital, so one cannot own share capital of another in the consolidated account. Now we're going to go through all of these things, but get that picture clear in your head. This idea, therefore, that it is a single entity, and therefore intercompanies, be they loans, be they assets, be they sales, can never exist, because you can't do things with yourself in that sense. Right, I think that this is a slide which is fairly obvious to most people as well. What it's saying is that in terms of the concept of the F7 examination, what's going to happen is that you're going to have a company A, it owns 50+%, more than 50% of the shares in the subsidiary. And so you're going to have the picture that we have here on the left. It's particularly badly drawn, doesn't it? Organisation A, which controls organisation Z. Now, in real life, and not only in real life, but in paper P2, so if any of you are paper P2 students, what you can have as well is you can have this idea of indirect ownership. If organisation A owns 51% of Y, it can control Y. And if Y owns 51% of Z, then Y can control Z. So can you see, therefore, that A effectively controls Z, even though it only owns a shade over 25% of the shares? It has control, because A will tell Y what to do, and Y in turn will tell Z what to do. Therefore, in the scenario we have on the right with A, Y, and Z, we have to consolidate those three companies. Even though the minority interest and non-controlling interest in Z is going to be something 74 point something %, they still need to be consolidated. So now this is actually relevant for paper F7. So now we've got here a little slide that we've called our criteria for consolidation. And you'll see here that the percentage of outstanding voting stock acquired, that's a very American phrase there. So what's the percentage of ordinary shares is what we're really looking at. If you've got from 0 up to 20, this is what we're really looking at, the different levels. And these things are normally called simply investments. So you show them in the balance sheet. I guess you can call them financial instruments if you want. And then at that point, what will happen to them is that usually we would, if we're holding them purely for investment purposes, we mark to market. So in other words, as they go up or down in value over the year, we'll put the change through the income statement. So that's 0 to 20%. Now it doesn't have to be. Certainly in terms of the stock market, the London stock market, for example, with the yellow book, the rule book, once you get to 5%, you have to start declaring your interest. And if you get to 30%, you have to actually launch a takeover. So at 0 to 20% for accounting purposes under IFRS 1011, you're normally not doing very much. Right, once you go over 20%, then we start to talk about significant influence. So you'll see there where it says level of economic influence, and the second one there in the quotes is significant influence. So with significant influence, now what's happening is standard number 11 tells us that we have to treat this thing as an associate company. Now you'll be equity accounting for it normally, certainly in paper F7 exams you'll be equity accounting. So we show the thing in the balance sheet at cost, and then every year we add to it our share of profits. So we have significant influence, or we have this idea that it will be an associate company. Once you hit 50% plus one share, you have control, and once you have control, then you have to consolidate the things. Okay, right, now that is relevant for paper F7. Okay, and the final slide gives you the exceptions to the 50% rule. So this is a situation where you actually have more than 50% of the shares of an organisation, but for whatever reason, you don't actually have to consolidate it. And the basic reason is either because you really don't have control, because there's something else in there that means that someone else controls the organisation, or that the thing is up for sale and you're anticipating getting rid of it in the short term. Okay, this comes under the heading of F7 because at the moment we're doing some F7 teaching for some clients, or at least some teaching which is basically F7, some basic IFRS teaching. If you are doing paper F7, I mean, thank you very much for sitting through this. I hope you found it interesting. It's stuff that you should know, and it's nice to know for the exam, but what you really need to be able to do for F7 is to produce the consolidated numbers. If you are, however, a student doing Graham Holt's paper at P2, then at ACCA P2 this is much more relevant for you, and you should be aware of what's in there. Okay, this is going to be really, there was a very short lecture about the F7 exam, but this really is the first exam. Now we're going to go on and look at how to actually do some consolidation. It's much more relevant for the F7 exams.